Hello. How's it going, everybody? Welcome to a Capital Hungry Monday Market Update webinar. Through the next 30 to 60 minutes, I will be doing some fundamental and technical analysis to map out some trade ideas and trade setups on gold, GBPJPY, GBPUSD, EURUSD, USDCAD, and the US 30 stock market index. Please take the time to go through and read the description as we have a flow and process to this webinar, and I'm just going to be jumping right into it now. Okay? So the first thing I'd like to do is understand what fundamentals we currently have on the table that are impacting the markets and how it's impacting. First thing I'd like to do is understand what fundamentals we currently have on the table. Issue. What about now? No, it should be good now, right? Are we good now? I think there was just somebody, I think everybody said it was an echo for a second. Okay, let's just quickly restart then. No big deal. Okay, so as I was saying, welcome to a Capital Hungry Monday Market Update and Trade Ideas webinar. Through this webinar, I'll be doing some fundamental and technical analysis on gold, GJ, GBPUSD, EURUSD, USDCAD, and the US 30 stock market index, while first going through what fundamentals are currently in play, recent news headlines from the previous sessions that impacted the markets and how they impacted the markets, economic events we have overnight, as well as current market sentiment. Okay? So, before we jump into the analysis, we just want to understand some of the key recent fundamental points that are impacting the order flow of the overall markets, as we've seen some very singular movement of smart money, especially since we've had these tensions come in with Ukraine and Russia, of course. Okay, so for those of you who noticed from last week on Friday, we had tensions with a deeper intent from Russia looking to invade Ukraine from the information we got from Kremlin, from Russia, right? This led to bringing some fear, uncertainty, and doubt to the markets in the short term, which led to a drop on equities, strength in the US dollar, strength in the Japanese yen, strength in gold, and also strength in oil due to potential war tensions developing, and of course investors and smart money starting to price this in as the market moves on anticipation. Okay, so we saw that fear to close off the end of last week, but as we started off this new week, that fear was still holding some strength through the Asian session and Euro session overnight, but started to dissipate as during New York session we got newer headlines from Russia, where Russia was confirming that they are still looking to take a more diplomatic approach. They're still fully ready to have actual constructive conversations about this, and they're not just going to be looking to invade right away. Something else, if you guys go back test, with the majority of military conflict in terms of impact on the financial markets, unless the military conflict is involving global parties and is also long-standing, usually the military conflict and geopolitical tensions regarding military conflict are very short-lived in terms of market impact. When you look at the average impact of military geopolitical conflicts on like the equity markets, on average it only leads to like a 1.5% drop when you're looking at the equity markets. So far what we have seen is the events from last week and Russia looking to invade but not actually invading yet. That's been priced in, that's been digested. It created its dip on the equity markets. We got headlines that Russia is looking to take a diplomatic approach. As these war headlines have been coming into play and we've been having the fear, uncertainty, and doubt developing around that, COVID went on the back burner. You know what I mean? COVID's been completely on the back burner. Everybody's been ignoring that. And we've also had central banks switching more into a hawkish tone, but nonetheless, they still haven't actually been aggressive with rate hikes, so global inflation is still very high. In terms of some news headlines that complement what I'm talking about, these are some headlines through the New York trading session that impacted the markets. So we had some market fear, but when Russia Minister Lavrov proposed to continue diplomatic work instead of just taking an aggressive military approach, this brought some more optimism towards the Russia and Ukraine tensions. Okay? What we also had was Federal Reserve speakers Fed Bullard discussing inflation and also talking about interest rate hikes. And we also had Ukraine looking to join the NATO alliance, the North Atlantic Treaty between North American regions and of course Euro regions. So we can see some of these news headlines like Russian Minister Lavrov proposes to continue diplomatic work. That is of course a more optimistic impact. Bullard inflation reports since October is showing that inflation is still very high and price increases will not come down or moderate unless the Fed take action. So the first headline and the second headline, they were still relatively more, the first headline was more optimistic. The second headline was still very bullish in terms of talking about inflation for gold. The second headline talking about interest rate hikes and the justification for a whole 100 basis point increase in the rate hikes for the US, that was a bullish impact on the US dollar. And also the last headline was more optimistic in terms of the Ukraine and Russia tensions, where Ukraine is looking to join the NATO treaty and alliance. What's really interesting is the US and these BPS's basis points, like decimal points for the percentile of the interest rate, right? Like 0.25 is 20.25% or 25 basis points, right? So anyways, so what's really interesting about the Ukraine-Russia tensions is it looks like who really wants war the most is the US. The US isn't willing to have a discussion about adding Ukraine to the NATO treaty and that alliance, but they're fully ready to engage in providing military support and engaging in military conflict if need be. So that's really interesting. But anyways, nonetheless, with those headlines, with the events in the order flow movement we saw take place through the New York trading session overnight, and just to start off the week so far, we can see the US dollar is still holding strength. The Japanese yen is relatively bearish as that fear is being waved off, and the equities are still holding their bullish strength when we're looking at majority of regions across the board. Equity buyers and equity volume on the buy side has slowed down due to the fear, uncertainty, and doubt, but nonetheless, the equity markets are still bullish. The dollar is still bullish because with the dollar, if we are to go into war tensions, that's still bullish for the dollar anyways, in terms of USD. But with the Federal Reserve already transitioning into a more hawkish tone and starting to talk about rate hikes and inevitable rate hikes coming in the near future, then that has already been all bullish fundamental factors for the dollar. And of course, we've been playing that dollar strength accordingly. Gold is also still very bullish on the higher inflation overall, and more importantly, the US inflation. And of course, the tensions, and gold was more bullish as a lot of the interest rate discussions by the Feds have been priced in. So gold as an asset class has been more bullish as well. Okay? So we can see, yes, global equities, when you're looking at the US 30 here, it's slowing down. The UK 100, it's a bit more bearish on the lower time frames. Japan market's a bit softer, but overall global stock markets across the board are still very, very bullish. So when you're looking at the US 30 here, our make or break point to really see long-standing fear or see sellers in play on US 30, we would need to break below this buyer demand zone at 34K, where no matter what catalyst we've had, whether it was Delta variant or Omicron variant or interest rate hike scares or even the war tensions, we haven't had any order flow, volume, or volatility to break us below this significant price point, right? And when we're looking at the Japanese yen, even though we had on Friday that short-term strength in the yen, which all of you would have noticed as your XXX JPY pair starting to drop, like Euro JPY, GJ on Friday when the headlines came out, again, yen is very bearish. The volatility index is still very bearish. I'm still looking to play yen pair buys like GJ buys. I'm still looking to play US dollar strength. I'm still looking to play stock market strength as long as we hold above that 34K price point. And so far, those tensions and discussions between Russia and Ukraine have been priced in. The markets digested it. It caused its dip in price setups. For example, when you're looking at the structure on GJ here, and don't worry, I'm going to go through the individual analysis. GJ on the higher time frames is very bullish, right? So you can see we had this pullback back to this previous demand zone, but as we had that optimism with Russia still wanting to take a diplomatic approach in the short term, it faded out that negativity, and we're still holding our higher time frame buys and Japanese yen weakness and still looking to play that sentiment, especially if we don't have any new fear to price in. New fear to price in would be Russia actually taking action in invading Ukraine, right? Where we have to understand we might have certain anticipations as manual retail traders, but when you look at these various war events historically, the starting of these various war events or military battles, it can go over a course of weeks or months. Then the actual conflict, it can go extend for years, right? Go look at the war on Vietnam. Go look at any war the US has been on with Iraq or Afghanistan. They go on for decades, right? Go on for countless years. So when people are trading the markets, we get so involved in the day-to-day and thinking like, oh man, any day a war can pop off. But it's not that simple. It's not that black and white, right? So you have to understand that. And for those of you who are wondering about the Russia tensions, about how the US is involved, how China is involved, how this can escalate, I will be uploading a webinar and presentation that I already did on that on YouTube this week for all of you. All right? Mr. Occult, you will have that answer in that webinar upload. All right? Okay, so anyways, now we understand the current fundamentals at play, what's been priced in, the market sentiment in terms of how equity markets are moving. We're still in a bullish bias on the US dollar on the higher time frames. We're still in a bearish bias on the Japanese yen. VIX is still bearish below 32. US 30 stock market index is still bullish above 34K. Okay? Now, before we jump into the analysis on the individual pairs and the trade ideas, we have to understand what economic events we have on the docket as manual retail traders. So for those of you who are trading London session overnight, we do have a lot of economic data to impact GBP as well as Euro pairs. Okay, so at 2 a.m. Eastern pre-London hours, we have UK labor market data, job change, unemployment rate, average earnings. This is like UK's version of NFP. It's not as big of an impact as NFP, but it's UK's version. Your unemployment rate, your job change, which this is like your non-farm payroll, and then your average earnings and so forth. Okay. I'm still seeing that overall the job sector has been relatively solid in the UK, but it will be having a minor decline off the heavy rebound as the UK has come out of lockdown. When the UK first came out of lockdown, there was a surge in the employment activity, but that always simmers down. So we will see a slight drop, but it's still in overall macro healthy numbers. And I still see GBP against the yen bullish, but GBPUSD is a different story because of the US dollar dominance as the world reserve currency, and dollar's currently bullish, but we'll talk about that in a second. 3 a.m. Eastern at London Open, CPI figures for Spain, monthly and yearly. It's a medium-term report, but it's still important inflation figures where Spain's data is going to impact euro pairs, okay? 5 a.m. Eastern at Asian session close and the end of the 4-hour candle and the start of the new ones. At both, right at that period, we have Germany's ZEW economic sentiment and current conditions report. I'm expecting this to be relatively off and weaker. And we have Eurozone's overall Eurozone's GDP flash estimate quarterly and yearly, where they're expecting pretty neutral figures. Okay. Reserve assets total doesn't have too much of a market impact. Same thing with like New Zealand's milk auctions. Then New York trading session, North American trading session at 8:15 and 8:30 a.m. Eastern. At 8:15 we have Canada data, housing start figures, where they're expecting stronger data. Real estate market in North America overall has been booming with the higher inflation and the flow of foreign investment in support of the central banks and low interest rates. And then at 8:30 we have producer price index data, inflation figures from the producer perspective for the US, and the New York Fed manufacturing business index report there. And then just some inflation figures from China tomorrow Asian session. Okay? Now, let's jump into our analysis. Gold. For those of you who have been following the Monday market updates or the live trading sessions from previous weeks, you would know ever since the 1810s and we failed to break this very strong demand zone here. Let me zoom out a bit. Okay? Very strong demand zone at the 1790s here and price sensitivity area that we failed to break multiple times. And what's also interesting is on the intraday time frames, every time we've had buy orders collected from this demand zone, we actually see gold buyers rally into higher highs above the previous highs, which is exactly what we're seeing now, okay? So we had a very strong rally with the Fed rate and that information being priced in, inflation still being high and weaker economic data. Then, of course, the Russia tensions, that continuing into this new week. And I still see gold as bullish and us continuing the rally. But with the way gold behaves, pullbacks are very normal. And when we're looking to the left at previous price sensitivity areas, both here, you can see a lot of supply zones in this 1860 area, 1870 area to the left. And even when we're digging up into the 1900s, if we were to break above here and have that continuous rally, okay? So we have to take gold in strides here. It's very normal, as gold has been overall trending a bit more bullish, that you do have aggressive pullback moves and aggressive pullback plays as buyers take profit, and you have those potential buyers taking profit, sellers jump in, pushes price down to a more favorable demand area, and you continue up. And honestly, if gold was to have a pullback to previous intraday highs at 1850s again, that would just mean better risk versus reward buys for us to scale and continue up, right? So one thing we have to watch out for is gold buyers just have printed a new high, and that high is digging into this price sensitivity area to the left at the 1870s. But current bullish momentum and bullish price action is extremely strong. Even though we have to be mindful of this 1876 area, right now, based on price action and buyers in control, there's no real signs of exhaustion yet, okay? So we're still playing the bullish bias. I'm just going to be looking for pullbacks to previous intraday high or 1855 key level buys. Remember, inflation is still high. We still have those tensions lingering, which is keeping gold relatively bullish. Feds have yet to take that action. Very nice bullish market structure with buyers consistently printing intraday highs. Any of the pullback phases are relatively short-lived. It's just buyers taking some liquidity out of the market, sellers jumping in, driving us down to a more favorable demanded price point before continuing up again. And I just want to continue that structure. but that's not the only options there, because it doesn't mean that we always have to have a pullback. When the market is trending, in the example of a bullish trend, we can have order collection in two ways. I'm just going to black out the screen for a second here, okay? So the order collection, when you're trending in a bullish market, you have on any trading instrument or asset class, you'll have buyer order flow and liquidity entering from a low price point. Whether it's from a positional perspective, on a stock, on a commodity, doesn't matter, right? The whole point of trading, the whole point of investing, scalping, positional trading, whatever it may be, is to put a risk and capital into the market to potentially see that asset class increase if you're buying it, or decrease if you're shorting it, to gain a profit on that change in price, and then exit out of the market and take that money off the table, right? And then you'd use that money, because it's the whole point of investing or trading. And because there's so many market participants involved in the modern markets, and all of the market trading is majority automated, you have institutions trading, high frequency trading within milliseconds. You have trading within hours, trading within minutes, long-term contract trading, position trading. There's always these waves of buyers and sellers entering and exiting the market being created across time frames. But the general concept is the same. In a bullish trend, buyers would enter the market. That asset class or instrument extends in value. They make money off of that. They want to exit out of the market. For them to exit out of the market, there has to be exit side liquidity. Short sellers jumping in on the other side, right? Or late buyers jumping in who think it's still going to extend up on a retail perspective. But the buyers exit out, sellers jump in hand to relieve them out of the market and provide that exit liquidity. This technically creates a pullback that we observe. That pullback usually will either go to that same demand zone or a 50% correction. You enter a more favorable demanded price point, demand zone, buyers jump back in, and you extend up, and you essentially repeat that process. And this is what will print your bullish market structure. But you don't always have profit-taking moves or pullbacks. Sometimes you can have a consolidation phase and continuation to the upside, where this is just buyer order flow being collected in the market. You're not breaking structure, and you have more volume to extend this asset class higher and increase the price of it, right? Very simple, understanding the movement of buyers and sellers transactions. And if you break that down, you can dissect any pair like that. For example, here, you see gold push up a bit, has a minor pullback. Here, it doesn't have a pullback. You consolidate, break out. Then you retest that demand zone, continue. Have some deeper pullbacks, continue. Here, you create a little bit of a order block, right? You can take any asset class, any trading instrument, and if you break it down, understanding that fundamental ideology of the order flow movement and what actually prints this structure, you can apply that to anything. And you can apply that to bear structure and the sell side as well. Okay, so we might not, with the current momentum, gold could easily just maybe consolidate at these highs and then just have a breakout and continuation to the upside. So we're not going to be counter trend trading. We're not going to be fighting the trend, and we're not fighting the current fundamentals. If a pullback happens, that's perfectly fine. We're anticipating that pullback's just to set up better buyer order flow, right? Because the overall market is still trending bullish there. So if we get a pullback to previous intraday highs or 1855, even to 52 again, I'd be looking for buys. Or if we just consolidate or have a minor pullback and break above 1876, I would also still be looking for buys. Okay, if it consolidates, let it consolidate, break out above 76, continue the buy breakout. Because the expectation is, if a consolidation gets created at these highs, something, let me show you guys an example that's not even this structure. I'll show you guys something to the left here, right? Let's look at this, right? Same idea. You have gold trending bullish here. Same idea. A bullish trend where it's going from 1760s all the way up to 1860s over a period of 2 weeks, okay? Right? But when you really break it down, buyers in control, you're having that very simple movement overall of price, right? You can see sometimes as you have a high printed, in this example, you have a consolidation phase created. You even have that here created as well. A lot of manual retail traders who only trade technicals, where they start to suffer is they go, oh, resistance. Oh, resistance. Oh, we hit an EMA, we hit a fib, time to sell. But unless you break below the consolidation zones, lows, or you break the bullish structure, 9 times out of 10, the consolidation zone will continue with the current trend, right? So what the anticipation is, if you have a consolidation zone, is when you break out, the breakout's going to lead to the new highs or have an impulsive move that you can play accordingly, right? You see that all the way until you have a shift in trend a month later. And then look, on the sell side, it's the exact same thing when sellers are in control and in play, making your way down in price for that extended period of weeks. Right? So when we're looking at gold here, it can easily just consolidate and have a breakout to the upside and not even have a pullback. But those are the trade ideas on gold. Inflation is still high. We have yet to actually see the interest rate hikes, okay? We still have those tensions lingering. Bullish market structure, bullish price action. We're playing those breakout buys or pullback buys at those price points given. Not too much to focus on in terms of US data tomorrow, just that PPI, which I still expect producer price index to be high, and I still expect the producer price index to be high, similar to the CPI figures previously, which also just helped gold continue bullish the prior week, right? So no point fighting this trend. Now, on our US dollar pairs, I'm still looking to play US dollar strength, okay? On GU higher time frames, on EURUSD higher time frames, we might be consolidating, but we're in overall bearish market structure. The same time dollar on the higher time frames has been bullish, as investors have been pricing in the inevitable rate hikes to come and the shift in policy stance by the Feds. Of course, war tensions just further support that, right? So my expectation is for February, after we had the Fed interest rate move and dollar edged up and printed a new high, it was perfectly fine. As we printed a new high, we had a pullback phase to this previous demand zone. Now that for the month of February, we created that lower wick, generated more buyer order flow from this demand zone, it looks very evident that we should start making our way back up to these highs. The Fed's talking about interest rates or actually raising rates is just another bullish factor for the dollar. War tensions, if they do come back to the table, is still just another bullish factor for the dollar. Current structure is very bullish, and the price action is bullish with potential to target these highs. Okay? The US dollar and gold are not directly correlated. US dollar is a currency of the US economy. Gold is a global economic pillar. It is a real physical asset and precious metal safe haven that's mined. It's hoarded by countries. It's hoarded by governments and by central banks. It's used in electronics. It's used in industries. It's used as a trading instrument, right? There's not a direct correlation between gold and the US dollar. At times, at certain times, depending what's going on fundamentally, there can be a correlation, but there's not a direct one-to-one correlation between gold and the US dollar. Okay? So on GU, overall, my anticipation as the same idea, bearish market structure, sellers consistently printing lower lows. We had a lot of sell orders collected in this area, and now we're creating what I'm anticipating to be a bearish order block of sell side liquidity as long as we hold below 1.36, where once we break below here, we should have a very nice move to this previous lows and overall start to be trending down playing this overall bearish market structure. Okay. Just because gold is priced in USD doesn't mean it's going to be a direct correlation there. Okay. So with GBPUSD, I still want to play that dollar strength, even if we come to the supply zone at 3.6, dig a bit higher and stay below 3.54, break below 1.35, I would be looking for sells on GU. Higher time frame bearish market structure, US dollar holding strength, and whatever pair the dollar is in, it holds a lot more weight as the world reserve business currency. Overall, just in a consolidation phase, safest sells below 1.35 and 1.348. Nice targets of previous lows at 1.34. Just a bit messy in terms of the intraday price action in this consolidation phase. Euro USD. Same idea, higher time frame bearish market structure. Sellers consistently printing lower lows. Euro USD is almost actually the inverse chart of dollar index because of the weight the dollar index, because of the weight the US dollar holds as the world reserve currency on a global scale. We had a lot of sell orders collected from the supply zone in previous lows, consolidation zone and break to the downside. Lower time frame bearish market structure forming, potential for low targets at 1.14. Even if we were to get deeper pullbacks to 1.36, I'd be looking for sells. If we just come and drop back below 1.31 and sells below 1.28 on Euro USD. The ECB hawkish move from the previous week was priced in, digested, wasn't enough to break higher time frame bearish structure. Sellers jump back in play, can see the exhaustion by buyers there, starting to form some bearish market structure on the intraday time frames. Dollar holding that strength. I want to play that dollar bullish bias and sentiment as stated here for those fundamental reasons stated. This means on USDCAD, I'm more in a bullish bias. It's just that USDCAD is more of the inverse, where you can see we've had a break of the bearish structure, stronger bullish market structure forming with the double bottom here, and now we've just entered a consolidation phase. The reason we've entered this consolidation phase is simply because both oil and US dollar have been bullish, right? So what we have to understand is there's huge ties with the movement of Canadian dollar and crude oil, as I talk about time and time again. With the war tensions, higher inflation, that still kept oil bullish, and we actually almost hit $100 a barrel. I think we were just shy a couple of bucks on Brent and on crude, right? So the Canadian dollar still been holding some short-term strength. The same time the US dollar strong. Fundamentally, you have this indecision of both those currencies holding strength. So technically, you get this large consolidation zone created. But I'm still anticipating this consolidation zone to be buy side liquidity, and eventually, as long as we don't break these lows, for us to have a break above the consolidation zone, continue that dollar strength, especially if we get a bit of exhaustion on oil, as some of these Russia tensions so far are priced in and we don't have any new fear events to further price in at the moment, we can see some upside up to 283 and so forth. Okay? Now, dollar, we're playing that strength bias, but equities are still bullish. VIX is still bearish. Japanese yen is still bearish. So even though on GBPUSD, we're looking for sells. On GJ, that's a different story because the secondary in the pair GBPJPY, the Japanese yen, which is a safe haven currency, is overall bearish in intraday and higher time frame market structure, as well as fundamentally bearish because there's been no demand in the Japanese yen from a macro perspective, because all the demand, all the liquidity's been in the stock markets, right? Been in these other asset classes like gold, real estate, oil, commodities, and so forth, right? So yes, you get some short-term fear spikes or pullbacks on the Japanese yen because we understand how the market waves go when you have the transactions between buyers and sellers entering the market, profit taking, creating those pullbacks and so forth. But overall, all of those pullback waves or bullish moves on the Japanese yen are always very, very short-lived when you're looking at the overall broad market structure here, right? And GBPJPY is completely different structure on the higher time frames compared to GBPUSD. It's very bullish, and what's also very interesting is this demand zone on GJ. Every time we have buy orders collected institutionally from this demand zone at 149s, as long as the yen stays flat, as long as we maintain the overall bullish market structure, we actually extend into higher highs every single time. So yes, we might be having a pullback here, but even if GJ was to come a bit deeper, overall it's looking like it's going to be making its way to new highs, which is a very common trend when we get institutional buyer order flow entering this area, and overall bullish market structure on the higher time frames, right? I know, of course, and the Bank of Japan wants a weak yen because it supports their import and export and brings them more revenue in terms of international business with other countries. Okay, so with GJ, what we can see is very nice bullish market structure. We had a more hawkish Bank of England prior. We had the strength back in UK equity markets, which even though they're exhausting, look at the UK stock market. It was just pulling back from all-time highs here. So far, the Russia fears have been priced in, and the Japanese yen is weaker. I would be looking for pullbacks to 156 or 155.8. I also got a buy limit myself. 155.5, 155.8, or buys above 156.5. If we can make a lower wick for the new daily candle, fail to break the previous low demand zone in PPL, high risk, high reward buy areas, breaks above 156.5, safer buy areas, scaling above accordingly with at least targeting the previous intraday highs in this bullish trend. As long as we don't have any new market fear overnight, as long as we don't have any new tensions regarding Russia and Ukraine, as long as Japanese yen stays flat as well, I would only sell GJ at this point in time and adjust to a sell bias below 155. Okay? Because if we do have war tensions come back to the table, for our other pairs, that's perfectly fine. War tensions and more aggressive war tensions, that just further helps our gold buys. War tensions will further bring dollar strength and help our GU sells, our EURUSD sells. UCAD would probably stay consolidating, but for GJ, war tensions would break our bullish bias on GJ if we get further aggressive military conflict, events that already haven't been priced into the market. Okay? Last but not least, US 30, higher time frame bullish structure. From a technical perspective, no matter what fundamental catalyst we've never had sellers break below this price point. Okay? So it's very interesting, like with Delta variant scares, Omicron variant scares, interest rate increase scares, we've never broken 33,600, 34K area here roughly, right? We haven't broken this area since pretty much May of 2021. Held it for almost a year coming up now so far. And I don't think we're going to break it until we have the Feds actually increase interest rates. I think it's going to take both war tensions and an increase in interest rates for us to break below 33,500. So as long as we're above here, we can have some pullbacks, but I can't start guessing sells. Now, trust me, if we get the surprise rate hikes or aggressive increase in interest rates, if we also get war tensions and we break below 33,500, put a big ass red box and put a sell stop at 33,500. Because if you have war tensions increase and you have the surprise interest rates, then you'll for sure have a drop. But still, anything above there until now is still fair game bullish buys. Right? So when we're looking at the intraday time frames, as long as we hold above this area, I'm still bullish. So I could see deeper pullbacks to 34K flat, but above 34K flat, I'm still bullish. 34,600, I'm bullish. 35K, I'm still bullish. As long as we don't actually have the interest rate hikes yet, we don't get any more new fear headlines, we still hold above 34K, we're still going to be bulls. We're only selling below 33,500. I'll even put a sell stop there, 33,500. Okay? All right, everybody. So, through this webinar, we went through the recent fundamental points and real-world events that are impacting the trading instruments that we analyze and trade every single day. We broke them down and understood their impact, but also how it's been priced in and what we can expect to see in the near-term future to come. Okay? We broke down market sentiment and the movement of order flow in some major market pillars such as the equity markets, Japanese yen as a safe haven currency, and the US dollar to use those confluences to our advantage in our analysis. We broke down some recent headlines through New York session and the impact it had on the markets and our analysis as well. Then we went through what economic events we have on the docket over Euro session overnight and of course New York tomorrow. And then we went through our analysis on each of these pairs and trade ideas, where those trade ideas at those price points of interest, you can scalp it or day trade it. And these are trade ideas that are valid for the next coming sessions as long as we don't have a shift in the current fundamentals, okay? And we don't have a shift in the current structure and those price points of interest. Now, at the end of the day, I know people really appreciate my analysis and experience and breakdowns of the fundamentals and technicals, but I'm only human. I'm just a guy like you sitting at my computer trying to learn and master these markets. I'm not always going to be right. Do your own due diligence, follow your risk management plan, follow your trading plan, and I hope you appreciate the value. I hope you guys appreciate these streams and information. All right, this is going to be saved and uploaded for you to rewatch. That's the end of this stream, and I'll see you all next time on Wednesday for the live scalping session. I've uploaded some educational webinars as well recently on this YouTube channel. Make sure you like, turn post notifications on, check out all your resources in the description, and I'll see all of you next time, all right?